So I might kick off first. So let me just quickly share my screen. Guys, can you see my screen? Yeah, perfect. I'm in charge of the Odin Mortgage business in Singapore in property lending. So I'll be sharing some latest insights on what's happening in the Australian property lending space. So before we dive in, for those who don't know me or who are new to these webinars, I wanted to spend a few minutes to introduce who's Odin Mortgage, what we do, and where we're at. And then I'll move on to some of the insights that I'll be talking to. So Odin Mortgage, we specialize in helping Australian expats and overseas residents who are looking to buy properties in Australia or review their existing mortgages to find a better offer in market. So we specialize in home buying, whether you're a first-time buyers, investors, upgraded, downgraders, we're able to serve you. And also from a refinance perspective, we actively monitor the market and have access to best home loan offers in market to help you save your interest expense or lower your repayments, or even reassess your existing property to assess equity value that's available. And why us? So like all of us on the call, so buying a property itself is complicated remotely, but then assessing your borrowing options, it's quite tedious sometimes, where not many banks in Australia or lenders in Australia have the expertise in borrowing in a foreign currency option for borrowers who are earning foreign currency. So we're the expert in that space and be able to provide you with the guidance. And also the way that we build our process is that it's a platform where we access 20 plus different lenders and help you narrow down your options to 3 to 5. So in that way, you can make an informed decision in a simple and easy way. And we've got our team behind you. So not only helping you throughout application to settlement, we actually help you beyond settlement throughout your life cycle of your property as well as home loan to make sure that you can continue to optimize your finance options. And the good news is that so we've got some big updates. So with a very strong demand from the communities, a lot of expat inflow to Singapore, and a lot of Singapore investors now shifting their interest to Australian property markets. There was a need for us to have our physical presence in Singapore. So I have recently moved from Sydney to Singapore to run our office in Raffles Place. So if you're in Singapore, drop by. We can meet up for a coffee or chat. So yeah, let's dive into the actual content. So as I mentioned, I'll be sharing some insights on what's happening in the property lending space, where Brad will be talking about the actual property market. So you can see the charts on the slide, but long story short, there are two trends that we're observing. One is that the interest rates are it started stabilizing after a year of or longer with non-stop rate increases. And in fact, RBA just made a decision about half an hour ago to hold the rate for March, which is again a good news for prospect buyers or existing mortgage holders. And then the second trend is that we're seeing the home buyers amongst both investors and owner occupiers are coming back. So unlike 12 months ago, where 45% of the new total lending have come from refinance, now that share has come down to 38%. And we're seeing a growth of this share from both investors and owner occupier, which is fantastic for prospect buyers. And then just quickly touch base on the rates. So as I mentioned, RBA has kept their rate at 4.35%. And also we're seeing the actual home loan interest rate are stabilizing as well. So in fact, the average variable rate and average fixed rate are now on par at 6.5%, which so although there's been too much fluctuation over the last 12 to 18 months, now that we're actually seeing some stability here, so which is a great time for you to, if you already have a mortgage in Australia, it's a great time for you to review your existing home loan. So if your rate is out of market, please come and talk to us, and I'm sure we'll be able to find a better option for you. So just to move on, so before I hand over to Brad to talk about the property, alongside the restoring, I guess the buyer's market, I wanted to stress one particular trend that I'm seeing amongst the expat communities as well as the overseas investors. So you'll see the two sort of columns here. So we call it a rushing buyers, where as the housing market and the property lending market are restoring in favor of the buyers, and we're actually seeing a lot of clients who have either started or are in the process of purchasing a property without necessarily planning thoroughly. So the landscape has changed a lot compared to now and over the last, say, 12 months ago, where not only the rates and the I guess the share of the buys versus refinance have changed. Lots and lots of lenders have tightened or refined their credit policies, especially for foreign income earners. So we're actually seeing some of our clients who come to us saying that they found a property, purchased a property, and settlements in 2 to 3 weeks, which is fantastic. But then those clients have relied on their past borrowing options, where the profile of their borrowing have significantly changed. So it caused a lot of the, I guess, the back and forth between the clients and the lender, and also, unfortunately, delayed some of the settlements. So I guess the point that I'm stressing out is that with the buyers who are rushing, getting into the middle of the property searching or buying, and haven't submitted their home loan application, it will cause uncertainty and create unnecessarily frustration throughout your home buying experience, and worst case that you lose out your property or delay on settlement. So I guess the value that we can bring in, or the service that we could bring in as an Odin Mortgage team, is that we can help you even if you haven't started your property searching journey or are in the early stage, because we've got a it's like some of us may have heard of this term pre-approval or home seeker application, which I think that it will be a really powerful tool in this market where the market is restoring for home buyers. So getting a pre-approval, it's pretty much in principle approval from a lender, that the lender would assess your profile based on your income, expenses, and balance sheet position. And that pre-approval would give you a confidence for between 3 to 6 months. And it's okay not to find a property within that particular timeline, because we can help you renew that pre-approval so that at least you have confidence on the finance side as you commence and get into the weeds of the property searching journey. And at the time, if and when you successfully find a place, it would actually improve your bargaining position when you're at the stage of making an offer, so that it helps you win the property or the purchase. And also, I guess most importantly, once you make a purchase, settling on the property on time is the most critical milestone. And pre-approval will actually save weeks during your settlement period, so that you're always ahead of your game rather than chase up. So I want to stress out that point, and we in fact do help a lot of our clients to organise pre-approval at no cost. So please do reach out. So so you can see the QR code here. So if you've got a phone with you, you can just scan it and book a time with us. Now, I think I'm close to my time, so just to quickly wrap up before I hand over to Brad. So three takeaways for today from Odin Mortgage perspective. So one is that it's a good news that the Australian housing market is in restoring compared to last 12 months ago, especially with interest rates stabilizing, with the government putting their rate on hold. And secondly, now the share between refinance and the home buyers, now we see that the buyers are coming back. And secondly, as I stressed out, if you're planning to purchase a property, or if you have an interest in the Australian property market, come and talk to us, because getting your finance sorted before you start your searching journey will be a really powerful tool for you to win, and also potentially save a lot of time and money for you. And then lastly, again, so I'm a newbie expat myself. This is my week 6 in Singapore. So we've just opened our office in Singapore. So if you have if you're in town, just come and drop by. Or if you're somewhere in Asia, just feel free to drop us a message for a video call. So yeah, on that note, I'll hand over to Brad to share more insights on the actual property market.
Yeah. Thank you, mate. There's some really valuable tips in there as well, just as we're sort of preparing to share our screen. And I'll sort of touch on some of those considerations throughout my presentation as well. But just confirming that you guys can see my screen now as well. Yeah. One of the big things to be conscious about, and sort of talking about your story about unconditionally committing to a property prior to having a pre-approval or some of the considerations in place with regards to finance, is the financial risk associated with that is really significant. It's certainly not an advisable consideration to effectively put yourself in a position where you're on the pathway to settlement and you still don't have an unconditional loan approval. Not only can you lose the property, but the side effects are that you will forfeit your deposit, which in the majority of state and territories is 10% of your purchase price, but you can also be sued for damages as well. So yeah, the idea of pre-approval, not turning this update into a mortgage-oriented update is significantly important for your property journey. So guys, as you can see, my name is Brad Purcell, and I am the National Head of Acquisitions here at Milk Chocolate. And at Milk Chocolate, we assist our clients to plan, buy, build, and manage Australian property. Now, our business has organically grown from the origins of primarily assisting our expat clients who are still living and working overseas to build their property portfolios, purchase their Australian-based family homes, and effectively create wealth through property. So the interesting component from our business is that we are actively purchasing and engaged in marketplaces across the entire country. So we're buying houses in every state and territory right now, with the exception of Tasmania and the Northern Territory, which means we get a very real-time and accurate sense of each marketplace within the country, and combine that with data to assist in making really informed decisions and observations. Because an interesting consideration is that the majority of property data that's available at one point in time is about 3 months old and isn't necessarily a reflection of exactly what the buying public is doing in real time. So when we can combine those two things together, it puts us in a really unique position to provide some relevant updates, particularly with the overall property market. So speaking of which, my objective today is to talk you through the current property trends for the Australian marketplace. And the most interesting place to start with is trying to get an understanding of where we currently are. And so toward the end of last year, you may have heard some dialogue or some news articles around what's called the V-shaped recovery. So it sort of leans into a little bit of what Stephen was talking about, which is the Australian property space. Effectively, when we're looking at the combined capital city values, went through a market correction where, off the back of 13 months worth of consistent interest rate rises, created a significant level of uncertainty, and toward the end also started to have a financial capacity impact on the Australian buying market, and ultimately resulting in an estimate of about 50% of the Australian buying market putting their property search on hold. And that saw some fairly significant declines in value, to the tune for the combined capital cities of 7.5%. So from April 2022 through to January 2023, property prices corrected by 7.5%. But effectively, since January 2023, we've seen a recovery in that. And there's a couple of key factors as to the reason why. But the reason why it's being labelled as a V-shaped recovery is that the property correction cycle was very short-lived and its recovery has been very significant, and it makes that V-shape, obviously. And in November 2023, the Australian combined capital cities surpassed the previous peak. So that means that not only have we recovered all of those losses, we're now in positive growth territory when we're talking about the combined capital city market. So what's important to look at when we're talking about looking back? So to get an understanding of where we're headed, it's important to understand where we've come from. And there's three key moments in time that a lot of commentators and property experts are looking at. And the first one is the onset of COVID. I know COVID sort of feels like a long time ago. However, its impact to the Australian property space was unprecedented. And so effectively, that's the starting point for the majority of economists when we're comparing different marketplaces in Australia, is where prices were at before COVID and the onset of COVID, and then through to the second stage of this pricing, of this timeline, which is the previous cycle peak to the recent trough date. So when each capital city peaked, and then how much those prices corrected, and then from the bottom of that trough date to current or to the most recent peak. And I'll explain that in a little bit more detail. So if we're looking at the commencement or the onset of COVID, we had a fairly unique circumstance. So traditionally, Australia's capital cities or Australia's marketplace is a fairly cyclical price point or a fairly cyclical price process, which means not every capital city is doing the same thing at the same time. Whereas the onset of COVID and emergency level interest rates at effectively zero, Australians weren't travelling, were saving a bucket load of cash. We had nothing better to do than to try and find new houses to buy, which basically prompted what's called an owner-occupier-led recovery. So lots of people with lots of time on their hands making the decision to purchase their family home. So at one point, owner-occupiers made up in excess of 70% of the buying population. Homeowners tend to make emotionally orientated purchasing decisions, which translated to very emotional premiums being paid because there was a significant level of demand and a very limited level of supply. And this is going to be a common thread throughout my presentation, is that key concept of supply and demand. Real estate is like any other commodities. It's all driven by the level of supply and demand. And so what we witnessed was that every single market was effectively doing the exact same thing, and that is unprecedented price growth. There are different varying rates of that growth. For example, Brisbane was the best performing city. Southeast Queensland was the largest recipient of interstate migration during that period of time. Lots of people were leaving Melbourne. People were leaving Sydney, and they were relocating to the sunny shores of Southeast Queensland. Its values increased by 45.3%, and that marketplace peaked in May 2022. And then the sort of unsurprisingly, Royal Melbourne was the worst performing capital city. And when I say worst performing, its values still increased from the commencement of COVID in April 2020 through to March 2022, still increased by 15.8%. However, it was the most locked down city in the world. It effectively curbed real estate as an activity. People couldn't lease properties, people couldn't sell properties for an extended period of time. And it was also one of the cities that saw the largest transition out of that capital city, which was affecting demand. So, but as you can see, there was consistency in the performance of every market at one point in time. Where it becomes a little bit more interesting and where we're more sitting today is that at the commencement of that change of that correction period, with the increase in interest rates, we started to see a return to a more cyclical marketplace where we had each market doing different things at different times. And so to call out a couple of highlights, we had Sydney, for example, was the first capital city that started its correction journey, partly due to the fact that it is the most unaffordable city in terms of its median values. And it seemed to be the most quickly affected city. We saw Sydney's prices start to correct quickly, and it started to correct fairly significantly. However, its recent peak in January 2020 is the bottom of the city market was in January 2022. However, what we've started to see now is that Sydney has almost corrected all of its values. So the previous stat I gave you before with regards to the V-shaped recovery was the combined capital city. What we're looking at here is each individual city. So there's The three strongest performers through this market correction period has been Perth, Adelaide, and Brisbane. Not only have they corrected all of their values, but they're well in excess of their previous market peak. And so they're currently what's called at a cyclical high, so new record price points. Sydney, there's some mixed data. Officially, Sydney is also at its at a new record high as well. However, sometimes CoreLogic revises previous hedonic value reports each month, and so statistically it's not. However, the data suggests that in a very short period of time, Sydney's going to be at a brand new record price point. And then you can see that Melbourne, Darwin, the ACT and Hobart in particular are yet to still reach the previous peak, which was prior to the commencement of this interest rate rise period. And so why that becomes very interesting is we can start to look at the intricacies of each capital city and why some cities are outperforming others. And what we're starting to witness is the common thread here is more about affordability and the perception of value. And that is partly related to the fact that we are under much stricter lending conditions with much higher interest rates than what we were at the onset of COVID. And so cities that offer more affordable options and a greater perception of value seem to be performing a lot better. So this is a little bit of a state-by-state overview. Again, I'm also conscious of time and some of my content can be fairly data rich. So I'll try and keep this concise, but consistently, generally what we're seeing across the board is that every marketplace in Australia is still is recovering its values. So prices are still rising. It's just the rate of growth which is changing. So Darwin, for the first time, Darwin as a capital city in the NT, for the first time in quite some time, has started to see some price rises. So its prices have been, there's been downward pressure on Darwin's prices for quite some time. It's started to turn the corner, and over the last 3 months, its values have increased by 1.6%. Sydney's prices have been rising for in excess of 18 months now, and we're starting to see the rate of growth slow down in Sydney. Again, attached to that concept of the perception of value, but also we're seeing increased stock levels in those marketplaces where values have been rising a little bit longer as homeowners' confidence with regards to their ability to sell and sell for a premium price is starting to see more property enter the market, and therefore that increased level of supply is starting to equalise that supply-demand ratio and creating a little bit more of a slowdown effect in terms of price growth. Perth, Adelaide are still witnessing consistent and quite above average levels of price growth. Perth is the most insane real estate market in Australia at the moment. It is ludicrous. It's actually a little bit dangerous from my perspective, the type of emotional buying behaviour that is taking place there. However, the data doesn't lie, and Perth's values have increased by 5.2% in just the last quarter. So the only locations realistically where we're starting to see still see some negative price growth is Melbourne and Hobart. Melbourne's is almost negligible. It has months where values increase, it has months where values come back a little bit, whereas Hobart is still consistently seeing declining values from what was significant price growth during that COVID period. But to lean in a little bit more about what Stephen was talking about, overall, the combined capital cities value index is consistently posting increasing values, and we're still seeing a recovering marketplace. Just on average, that rate of growth is starting to slow down. So with a bit more understanding of where we've been, what does that translate to where we're going? So uniquely, we're in a fairly sensitive position, I think, for majority of capital cities at this point in time, where there's a little bit of a push-pull in terms of value. So there are some key considerations that are placing upward pressure on housing prices, and some considerations that are consistently putting downward pressure on housing supply. And what's going to be interesting is which one of those is going to have the largest impact and how that's going to translate to values moving forward. So some of the key things, and again, just conscious of time, I'm not going to go into these intricately, but the Australian government, Australia, we're actively seeking to increase our migration rates, to improve our skilled workforce and all of those types of things. So we're seeing increasing population, but we're most definitely not keeping up with housing supply. So the undersupply of new housing is putting upward pressure on established housing prices because there's just not enough houses for people to live in. So therefore that supply-demand ratio becomes consistent. The consideration for relaxed lending, now that hasn't come into effect yet. All lenders are still assessing with a 3% buffer on serviceability, but there is conversation floating around about potentially relaxing some of that serviceability assessment. And Stephen might touch on that a little bit later in the Q&A. Now, if that happens, for example, at the moment, that 3% buffer, if that gets halved to a 1.5% buffer, all of a sudden people's serviceability can increase quite substantially, which would then put additional upward pressure on pricing. Population growth is obviously another consideration, but for me, the Australian general public, the most important thing is social proof. We very much have a herd mentality. If it's popular in the media, if it's popular between friends, it generally becomes the truth. And the biggest consideration for a revision to quite accelerated price growth is the concept or the conversation around interest rate cuts. And it may not even take the first cut. It's going to be the strength of the dialogue around that interest rate cut happening, which starts to see any dormant potential purchasers stepping back into that fold and increasing that level of demand, because we do have a very significant and below average level of available stock in the majority of capital cities. And the caliber of stock is also inferior to what we're traditionally seeing, primarily because most owner-occupiers are still choosing not to sell their family homes. The majority of homes that seem to be entering the market are more investment grade stock. And so therefore, the quality supply of good stock is still seeing a lot of competition for the majority of homes in most capital cities. In terms of potential downward pressure on pricing, worsening housing affordability, so we're still seeing prices increase. We're not necessarily, we're still suffering a cost of living explosion here in Australia as well. So housing affordability is a key consideration that may see prices that downward pressure on prices. The risk of inflation returning to put upward pressure on interest rates is a consideration. Rising unemployment due to those inflation and cost of living constraints. But the other important one for me, and I'm matching up this, what I'm calling the established housing flood, with also the evidence of potential rate reduction as the two biggest potential drivers, is that limited available stock supply. If over a very short period of time that social proof changes and we start to see a large amount of stock coming onto the market, sort of what we're seeing in Sydney, sort of what we're seeing in parts of Brisbane, where we see more of that equilibrium between supply and demand, that is likely going to take a lot of steam out of the market and potentially start to see prices either correct slightly or that rate of growth slow down to a far more sustainable and long-term average. What we're potentially seeing on the ground, though, in real time, is that we're seeing the majority of auction clearance rates stabilize. So during that price correction period, auctions clearance rates were declining, but in markets like Sydney, in markets like in Melbourne, which are the most dominant auction-orientated markets in Australia, we're seeing very consistent auction clearance rates. Sydney's are in excess of 70%. Which talks about that supply and demand health. There's certainly still a lot of people actively purchasing property. The ACT, which is almost exclusively an auction marketplace, we're seeing consistent increase in auction clearance rates, which is talking about the re-emergence of demand in that marketplace as well. Other interesting considerations that are a little bit of a forecast here is price segmented market performance. We're starting to see different price points within the same marketplace perform different rates. So, and it's generally attached to affordability. So in Sydney, for example, the lower price point, this is a little bit scary to say, but anything sort of 2 million and below, we're starting to see much more shorter days on market, much more buyer activity. But that gap between sort of, let's call it 2.5 and $5 million, which is a little bit of an interesting market where there's still potentially a lot of debt attached to that particular price point, isn't performing as well. And then we've got the uber premium end of the Sydney market, which is disconnected from your traditional drivers. That marketplace is consistently always performs well. The fear of missing out, though, due to that stock shortage, so that FOMO buyer behavior is very real. A lot of people are afraid of not being able to buy a house, so therefore that's creating emotionally driven pricing decisions and responses. Generational wealth transfer is a real consideration here as well, particularly in your big capital cities like Sydney and Melbourne. There are lots of baby boomers, lots of mums and dads that are liquidating assets to help their kids enter that property market space. And so that's buffering some of those affordability considerations that's happening. And the other one that's interesting to talk about is that real estate agents are still engaging with a significant amount of potential sellers all the time. It's just that stock isn't necessarily translating to being available on the market at this point in time. Why that's interesting is it's a little bit of a forecast what we might be seeing over the next 2 to 3 months or the next quarter, which is 3 months. So sort of repeating myself there a little bit. So effectively, my summary for that is there is a lot of potential for either fairly significant increase in growth or a little bit of a slowdown in price growth, depending on which of those levers is going to be pulled the most from the overall macroeconomic standpoint in the marketplace. Our forecast at the moment is that we're likely going to see consistent price growth. What seems to be winning that push-pull battle is the upward pricing pressure drivers. And so our feedback at this point, if you're thinking about purchasing right now, and this lies in heavily with what Stephen was talking about, is you've got to be ready. So understanding what your parameters are. So speaking to your mortgage broker to get your pre-approvals ready to go so that you can have the confidence to proactively participate in the market, because there's not a lot of stock. Your search is likely going to take a fairly long period of time if you're being really focused on the asset selection component of your search. But also you're going to be competing with people. So you need to ensure that your conditions attached to your offer are as healthy as possible to give yourself the best chance at remaining competitive. And the other thing that can sort of lean into that is research. Research will save you valuable time. Getting an understanding about median values in the area that you're potentially looking to purchase in, and actually know what a median value is, because if you're looking to buy a caliber asset, I guarantee you it's not going to be at the same price point as median values for a suburb. So if your median value suburb data is 1.6 million bucks and your budget is 1.5, without trying to sound too negative, the likelihood of you being able to secure a really good quality property in that suburb is pretty slim. And sometimes we find a lot of people just want to try, and they may wait or try for 2 to 3 or 4 months before they realize I can't afford this suburb. The issue is, in a marketplace where we're likely going to see continually increasing values, by the time you've made that decision to change location, you've also priced yourself out of probably the suburb that you could originally afford in the first place. So getting an understanding about what you want, what the most important decisions are for you as a purchaser, the key locations where you can afford and what you're affording, your parameters are some of the most important elements to really effectively start that purchasing journey. I'm running out of time, so I won't talk too much about the real estate fundamental stuff, but we will make all of this information available through the team at Odin as well, so that you guys can reach that. And obviously, if there is any further information that you want to get, we offer one-on-one sort of consultations as well. If you want to get a little bit more in depth around what your objectives are, you're welcome to reach out to my colleague and co-founder of Milk Chocolate. His name is Michael Cleary, but or through the guys at Odin as well can put you directly in touch with us. But hopefully that's given you, it feels that there's a little bit of information there, but hopefully that's given you a little bit of a sense about what we're seeing on the ground here in the Australian property space. And the man who gets the most questions is up next, which is Bradley Murphy, because he's got all the tips to help your dollars go a little bit further. So I'll hand over to him.
Alrighty, can you guys see my screen? Okay, perfect. Yeah, well, thank you for those kind words, Brad. Hopefully that's the goal of this webinar, to help save clients some taxes, and I hope with a firm to speak to about that for sure. But yeah, just a bit of background about myself and the firm. My name is Brad Murphy. I'm the director at Murphy Tax Advisors and Lawyers. We're a specialised Australian, international and expat tax firm. We specialise in assisting Australian expats over the world with their Australian and international tax affairs. And the key focus for us is really providing integrated and joint tax advice in both Australia and the expat country of relocation. So we think it's really important not to look at one country in isolation, but really give joint and integrated advice and map out a real short, medium, long-term roadmap for our clients, looking at their short-term tax needs versus medium and long-term goals as they move into retirement. We do expat tax planning and compliance services too. So I think I'll just jump in to an important update regarding Australian tax residency. Obviously, the key focus of this presentation is regarding the Australian property market. However, tax residency is a really important concept for Australian expats in particular. It does drive a number of tax outcomes, and effectively most people obviously want to break Australian tax residency and have their employment income normally not taxed in Australia. But at present, it is really a key focus of the ATO through immigration records and through AUSTRAC records, money transfers coming into Australia. So I think it's just really important that clients understand the test to be satisfied. And the real key one is what we call this permanent place of abode test for an Australian expat moving overseas. If we use Singapore as an example, what that really entails is having accommodation over in Singapore, spending at least 2 years in Singapore, having employment and an employment pass over there, and at the same time really cutting ties to Australia. So I think that this test is really not that well understood by a lot of people. The concept of not spending 6 months in Australia being enough to not trigger tax residency is not always true. So I think really make sure you get advice regarding the permanent place of abode test before your relocation out of Australia. The other important point is that there has been some new rules flagged by the Australian government, the so-called 45-day rule, which has caused a fair bit of media uproar in recent times, which was part of the 22 budget by the Australian government. It's currently not actually a law as yet. It's only a proposal at this point, but this rule effectively will say that spending 45 days per income year in Australia may be enough to trigger residency of Australia. Now, as I mentioned, there's been no announced start date or any sort of draft law yet, but just watch this space carefully. The other important point is to consider Australia's tax treaties as well. Obviously, Australia and Singapore do have a tax treaty. There is currently not one with Hong Kong at this point. So it is entirely possible to be a dual tax resident of Australia and the foreign country. And luckily, if it's somewhere like Singapore, it's quite often easier to alleviate double tax as compared to somewhere like Hong Kong, where there is no treaty. So always just bear in mind the tax treaty can actually really give some good outcomes to alleviate double tax. So if we look at the Australian property market as it impacts Australian expats, I think as an overall comment, non-tax residents of Australia do normally face a higher tax burden on Australian property than Australian tax residents. And that's really driven by three key things. First off, there's normally higher capital gains tax to be paid, higher income tax on the rental profits, and thirdly, higher land tax rates. So really important to get advice before buying Australian property, because there can be some structuring to be done to help alleviate some of that tax burden and to make it more tax efficient. But I think the biggest change we've seen recently that was announced in 2020 was that the main residence exemption, which was available to non-residents, has been denied going forward. So if you're a non-resident and you sell your former Australian home, unfortunately, you do get stung with full CGT from now going forward. So really important to plan on selling your Australian main home while you're an Australian tax resident, if possible. So either before you do move overseas, or if you obviously come back to Australia, commence tax residency of Australia and sell it at that point. There is an important 6-year period, which can be very helpful as well. And in the context of that 6-year rule, effectively, you can rent out your Australian property for a period of 6 years and retain the full exemption for that 6-year period. But the important point would be to make sure that you do return to Australia, become a tax resident, and sell the property once you're back in Australia. So yeah, certainly something to be mindful of if you have an Australian home and you decide to move overseas. Just be mindful of that rule and give some thought to that 6-year rule too, which can be quite helpful as well. The other important point for foreign buyers is that non-Australian citizens and non-Australian permanent residents are subject to an additional 8% foreign stamp duty when buying Australian property. They'll also need to get FIRB approval. So normally it would make sense either to wait until you get PR to avoid that 8% duty, or have the property acquired in the Australian citizens or spouse's name. If we look at the investment property side, so effectively the Australian rental income, so the rental income less all the expenses, including interest on the mortgage, is subject to a 32.5% tax rate for non-residents. If it's a negatively geared property, the rental loss can be carried forward indefinitely to offset future taxes in Australia. So similar rules that apply for Australian tax residents. One important, I guess, burden for Australian expats is the loss of the 50% capital gains discount for the period that you own the property and live overseas. And this is where potentially having an Australian trust to acquire investment properties can be quite helpful, in that normally you can retain that full 50% discount by using a trust. And you do have the option to distribute the income from that property to Australian beneficiaries or a company in Australia too. And normally the tax outcome can be a lot better by having a trust at play, but not always. Of course, it does depend on everyone's personal situation. So just make sure you get personal advice. The other key point is land tax rates applying now. Well, they've always applied, but they've definitely increased in recent times. So just be aware that land tax may apply as well, depending on what state you buy the property in. So looking at some Australian structures to acquire property, really the key three structures that could be used to acquire Australian property are the family trust, which is probably the most common vehicle to be used. The self-managed super fund may also work, particularly for commercial property in Australia. And thirdly, an Australian company as well may also work. But if you're looking to use a family trust, just be aware a couple of key points there, that it must have an Australian director on the trustee company, someone that lives in Australia. With the self-managed super fund, it also would need an Australian director to be power of attorney of that fund. Otherwise, the fund can be non-compliant. So if we look at other implications of becoming a non-tax resident in terms of investment income in Australia, so effectively non-tax residents of Australia are subject to Australian tax on their Australian source income, which basically includes any Australian rental income from property in Australia, as mentioned, any dividend income coming from Australia, or Australian bank interest subject to a 10% tax. But yeah, just be aware that even when you do leave Australia, if you do have that investment income coming out from Australia, you will be required to file an Aussie tax return and make sure you're compliant with your Australian tax filings as well. The other key point to make is that Australian expats can still contribute to their super. So there can be some benefit in making concessional contributions to your super. Excuse me, I was come down with COVID last night, so I've got a bit of a sore throat, so bear with me. But there's definitely still benefits to making concessional pre-tax contributions to your Aussie super fund. And the annual concessional cap is currently 27,500 you can put into super pre-tax. And that can be helpful to alleviate some of the Australian investment income burden. The other upshot is that if you don't utilize that annual concessional cap each year, you can actually bring forward that annual cap over a period of 5 years. But that can be really helpful if you're an expat that hasn't put money into super, given you've been overseas for 5 years. When you come back to Australia, you can actually roll in that 5-year period into your Aussie super to help offset some of your employment income when you do come back to Australia. And obviously get money into the super fund is always advantageous from a retirement planning perspective as well. If you look at just a couple of quick tips for Australian expats, either leaving Australia or moving back to Australia. One issue we often find that does get missed by expats leaving Australia is to consider making a deemed disposal when they do leave Australia. Now, effectively, when you become a non-tax resident, there's an exit charge that can apply that looks at any gain you have on investments when you leave Australia. It does not apply to Australian property, only applies to non-property assets such as shares or cryptocurrency, for example. I guess the upshot of making that deemed disposal is that any future growth of those assets after you leave Australia is outside the Australian tax net. So yeah, assuming the gain is relatively small or manageable when leaving Australia, there can be some utility in making that election, and then any future growth can normally remain outside the Australian tax net. As mentioned before, always look at making that concessional contribution to your super if you've got investment income coming in from Australia. If you have a family trust in Australia, just make sure that you've got your trust minutes done before 30 June. It's getting a bit more focus from the tax office these days to make sure those distribution minutes are actually done before the end of the tax year, not when you lodge your return. So just make sure they're actually in writing before 30 June. And finally, as everyone's probably aware, if you're on a tax agent portal, you get an extension to file your return to May after the end of the tax year. So you can buy yourself an additional 8 months there for your filing deadline. Some tips on returning to Australia. So from a capital gains point of view, normally it's somewhat beneficial returning to Australia in that your foreign assets get rebased to market value when you come back to Australia. So if you have Singapore or foreign shares or investments that you've acquired from outside of Australia, they get reset to market value when you come back to Australia. So you're effectively paying Australian CGT, any increase in the value of those investments after you return to Australia. And normally one's Australian tax residency start date would be the date that one comes back to Australia. So on that date during the income year, as opposed to the whole tax year. Just be mindful of that as well. Some issues we do see in practice would be just making sure any employment payments via bonuses, termination payments, employee share vesting, try and get paid out before you come back to Australia to avoid being taxed in Australia. The other one is any sort of foreign super funds, so the Singapore CPF or the Hong Kong pension funds. Just make sure that they're ideally paid out before you come back to Australia, as Australia would tax any payment from a foreign pension fund if it happens while you're back in Australia. Yeah, I mean that's all I've got for today. But feel free to please give me a call or email with any questions, and yeah, I'm happy to have a chat. Yeah, I might throw it back to Stephen to run the Q&A.
Awesome. Yeah, thanks so much, Brad, for all the tips and insights to save dollars, and a lot of great observation and insights from Brad on the property market. So we got about 10 minutes, so let's dive into some of the questions that we've got. So I can see some of the questions are coming through the live Q&A, but there were a couple of questions that were pre-registered, so I might read them out. So this is more for noting. So the question around the 6-year capital gain tax exemption were quite popular, but I think, Brad, you've covered them very well. So any questions, I think we can reach out to Brad, or were there any other points that you wanted to highlight?
Yeah, obviously it's a very popular question. I think the key point there would be that you do have the option to rent out your Australian home for 6 years and retain the exemption in full. There's certainly a good option for Aussie expats to utilize that 6-year rule, because as long as you come back to Australia and sell the property as an Australian tax resident, you'll get that 6-year period free from tax. So yeah. And I guess
Cool.
around that question out, Stephen, if the property was rented for more than 6 years, then effectively the period from year 6 is the taxable period. So if you do decide to rent the property out for more than 6 years, you'd start paying tax from year 6 onwards on a pro-rata basis.
Great. Thanks so much for the clarification. So hope everyone noted that down. And the second question is around what other tax rules should I be aware of when I move back to Australia, which you did share some tips right before we move on. Were there any other call outs you want to share?
Yeah, that's a good question. Yeah, we did cover some of the key points. I think the other key point would be to consider your visa status in Australia. If you're coming back as an Australian citizen or PR of Australia, you're effectively inside the Australian tax net, from day one, and subject to global income and CGT from that point. However, if you're a temporary resident, so you hold a temporary visa, highly skilled visa, tourist visa, student visa, then effectively any foreign income is not taxable in Australia. Any foreign investment income is not taxable. So that can obviously be quite helpful, but just be aware that if you're not an Australian PR or citizen, you are subject to some of those nasty foreign taxes on Australian property as well. But I think that's obviously quite a broad question. So perhaps just drop me an email and we can have a chat about some of those issues. Yeah.
Perfect. Thanks so much. And then I'll probably pick the last question before we move on to the live Q&A. So I'll take this one. So the question was refinancing of properties in Australia for foreigners. So to me, that's more of a statement, but I I can assume the question is how hard is it viable? So long story short, it is viable to refinance your property in Australia as a foreigner or non-resident. So in fact, Odin Mortgage would partner with not only Australian lenders but also international banks in Singapore, other Asian regions, where we do observe a lot of our non-resident clients or overseas investors who have previously purchased a property through an Australian lender when they were in operation offshore. But then most of the Australian lenders have sold their operation or seized their operation in Asian regions and actually moved back. So a lot of those clients who have purchased property in the past are kind of stuck. But again, so we do have access to Australian lenders and international banks who may be able to give you an option to potentially save your interest expenses or find a way to optimize your existing mortgage as a foreigner. So please do reach out. Yeah, so let's move on to some of the live questions that are coming through. And if in case we run out of time, we'll take those questions offline and come back to you with a response separately. So please do enter your questions. So the first one, Brad from Milk Trolley, I might throw this one onto you. So the question is, would regional properties still appreciate? What's your view in regards to Gold Coast and Sunshine Coast in Queensland?
Yeah, it's a good question. So what we've sort of noticed over time is that regional markets sort of collectively haven't fared quite as well as capital cities. So their price correction journey was just as significant, but the recovery hasn't been quite as strong. The exception to that, though, is those two particular markets that the person asking the question is a reference. So the Gold Coast and the Sunshine Coast are probably some of the healthiest markets in Australia, with the exception of Perth. Because realistically, they're not really regional markets anymore. They're fully fledged independent cities. They have their own airports that fly internationally. They have significant rates of employment opportunities. And so from a milk chocolate perspective, when we're looking at regional marketplaces, particularly since the onset of COVID and the introduction of more flexible working arrangements, even though some of that's being repealed, connectivity to a traditional CBD is really important. So both the Sunshine Coast and the Gold Coast, the Queensland State Government have significant infrastructure projects to connect those marketplaces to Brisbane. So the ability to commute from the Sunshine Coast to Brisbane is really efficient. People can still do that on three days a week, but the lifestyle that gets created is quite significant. And the Gold Coast its price growth has been crazy. And realistically, those markets don't necessarily demonstrate any signs of slowing down, because if you still compare their values in comparison to, say, Sydney, you can get a whole lot more real estate for your money. So those two marketplaces specifically, doesn't look like there's too much writing on the wall to suggest there would be significant price correction, only probably continued price growth. When you start to get to further outer reaching markets where your disconnection from a capital city and access to key pieces of infrastructure and diversified employment opportunities, they're the markets that become a little bit higher risk. So during COVID, that wasn't a factor because everyone was going to live, on an island somewhere and life would continue, but hasn't necessarily remained that way. So that's our sort of key consideration. We generally put about a 3-hour limit on a regional market and how it can access the CBD.
Awesome. Thanks, Brad. I think next one, Bradley, back to you. I think this is a good question to clarify. So it's from Hoytak. So I'll just read out the question. So Brad, typically non-resident includes any Australian citizen who are living overseas and not a current tax resident. Is that correct? So non-residents will be a foreign buyer who has to pay an extra 8% stamp duty. And the follow-up question is also, do foreign buyers / non-residents who are Australian citizens need further approval?
Yeah, that's a good question. So there's definitely a distinction between non-tax resident versus a foreign person, right? So effectively, you can be an Australian citizen, Australian permanent resident, and live overseas and be a non-tax resident. Now, Australian citizens or Australian permanent residents are not subject to these foreign stamp duty surcharges. or FIRB approval normally. So you can certainly, as an Australian citizen or Australian PR, buy Australian property without being subject to these nasty foreign stamp duty charges, which is good news for Aussies overseas. In contrast, right, non-tax residents mean effectively somebody that's not residing in Australia. So an Australian citizen that goes and lives, let's say in Singapore for 5 years would normally not be tax resident of Australia. So the contrast there would be, Australian citizens, PRs, not subject to these foreign stamp duty taxes. However, if you're non-tax resident of Australia, you are still subject to the same main residence tax rules. So if you sell your former Australian property as a non-tax resident, then you'll pay full tax on that. So definitely different concepts there. But I think the other point too, which I think I'll just answer this question quickly, Stephen, ties into that question a little bit. What needs to be done to re-establish Australian residency to sell the main home? Effectively, it would just mean coming back to Australia for that year before you sell your property, and normally being in Australia for at least that income year when you sell the property. Yeah.
Perfect. Amazing. Yeah, thanks so much for the clarification, and again, another great insight. I'm afraid that our time's up, so we only got 1 minute. So I think it'd be good to wrap up. But we'll probably take these questions, the unanswered questions, away, and then see if we can post them or share those with you in a separate channel, so that you can maximize the learning and the insights from this webinar. So I guess where to from here? So we'll be reaching out back to all of the attendees, and for those who registered but haven't been able to make the webinar, for a thank you, but then also share the contact details of ourselves. So for any tax or legal advice, that we could share the contact detail from of Bradley at Murphy Tax. And then also for any support that you need on the insights or data or actual property searching, that we could share where we could share where to go to in Milk Chocolate. So thanks so much for everyone for your time, and again, Bradley, really appreciate your time and the insights, and we'll speak soon.